Are cryptocurrencies just another bubble waiting to burst? If you've been following crypto for a while, you've probably seen the wild cycles of prices skyrocketing and crashing. But do these roller coaster rides mean crypto is doomed to fail, like the tulip mania of the 1600s or the dot-com crash of the early 2000s? Let's break down what a bubble is and see if crypto fits the bill. A financial bubble happens when the price of an asset, whether it's stocks, real estate, or even something as unexpected as tulip bulbs, soars way beyond its actual value. It usually starts with speculation. People buy not because they see real value, but because they think prices will keep climbing. More people jump in, driving prices even higher and making the bubble bigger. But it doesn't last. Sooner or later, reality hits. People realize the asset isn't worth the hype. Panic selling starts, and the bubble bursts, leaving behind heavy losses. This is exactly what happened in the first recorded bubble, the tulip mania of the 1630s. Tulip bulb prices hit absurd levels. Some even cost as much as a house, before crashing almost overnight. History has seen this pattern repeat itself again and again. The dot-com bubble of the early 2000s saw tech companies with just a website and an idea valued in the billions, until the crash wiped out trillions of dollars. A more recent example is the 2008 housing bubble, where overvalued real estate and risky loans triggered a global financial crisis. These bubbles share the same traits: speculation, overconfidence, and a painful collapse. So does crypto follow the same script? Critics argue it does. The crypto market often sees prices skyrocketing due to speculation rather than intrinsic value. Some even claim it lacks intrinsic value altogether. Many people invest not for the technology or its long-term promise, but to profit from price hikes before the next crash. A major factor in this is FOMO and hype, key drivers of bubble behavior. Media coverage, success stories, and even celebrity endorsements amplify excitement, pushing prices to unsustainable levels. Proponents, however, push back against the bubble narrative. They highlight crypto's resilience and evolution. Yes, the market has entered bubble-like periods of overvaluation and seen dramatic crashes, but it has also rebounded stronger each time. These recoveries are driven by growing demand and increasing global adoption. Institutional investment adds weight to this argument. Companies like Tesla and MicroStrategy now hold cryptocurrencies on their balance sheets. And financial giants like JP Morgan and BlackRock have integrated crypto products and services. This institutional involvement brings resources and credibility, making the market more robust. Importantly, cryptocurrencies stand apart from past speculative assets. They're built on blockchain technology, a transparent system that minimizes reliance on banks and governments, though the degree of decentralization varies across projects. Bitcoin, as the pioneer, sets a high standard for decentralization and is widely seen as a benchmark in the industry. For the first time, people around the world have direct control over their money in ways we've never seen before. So the reality likely lies in the middle. While speculative behavior drives much of the market, the advancements in blockchain technology and its potential to disrupt traditional systems can't be ignored. As the space grows, separating real innovation from speculation will be key. And above all, this is a good reminder to always do your own research, understand the risks related to crypto, and decide whether its long-term promise aligns with your goals and beliefs. A great place to start is here, where we break down why Bitcoin has value in the first place.